Welcome to the Penny Stock and Cryptocurrency Survival Guide. Before we get into the class itself, I want to give you a little bit of context. The class I put together several years ago, but the key thing here is that the class is about emotions and psychology. And with emotions and psychology, because we're human beings, they've always been around and they will always be around. So what you learn about has been valuable, still is valuable, and will be valuable in the future because we're humans. We're always going to have anger, greed, overconfidence, sorrow, freaking out. All those things have always been around and will always be around. And the key is when you understand those dynamics, as cruel and mean as it sounds, you can leverage those dynamics against other people. If you understand how other people are feeling, how other people are viewing different circumstances, then like I said, you can leverage that to put profit in your pocket. Yes, that sounds mean, but that's how the financial markets work. It's understanding how other people are feeling and believing and then using that to your advantage. The other note is that this course is based around penny stocks, but please realize this for you crypto traders. Anytime I say the word penny stock, you realize that you can and should replace that with a cryptocurrency. Anytime I'm talking about an exact penny stock, please realize you can and should insert in any sort of coin that you may be looking at, because the emotions and psychology is a perfect parallel between penny stocks and cryptocurrency markets. And it's a way that you need to go into surviving penny stock trading, crypto trading, or maybe you're going to do both. But you better understand how what I call the wilderness works, because if you can understand the wilderness, you're going to give yourself a way better opportunity to make money as a whole. So let's go to my desktop and let's get into the class. For this video, we're going to go over the fundamentals of penny stocks and the stock market. If you've been around for a while, then I'm sure you could get away with skipping over this video. So I won't be too offended if you want to do that. But if you want to just go through the whole course, and definitely watch this video, obviously. But again, if you've been around for a while, then you could easily get away with probably skipping this course. But regardless, for those that are newer to the market, this is definitely an important video. So we're going to go through some fundamental stuff here, the ABCs of penny stocks and the stock market. So just first off, in an introductory type fundamental video, the first question is just, what are penny stocks? Well, there's no official definition. You could ask 10 different people and probably get 10 different opinions and definitions. So for us, we're just going to base it on the price. Some will base it like us on the price. Others are going to want to know what exchange it trades on. But for us, we're just going to call penny stocks anything that trades between 0001 up to $5. You may be thinking, well, how is a penny stock something that trades above $5? Well, some of these penny stocks, they end up going higher than $1, and depending on how things go, they can even sometimes go higher than $5. But for the sake of this guide, we're just going to be talking about anything from 0001 to $5. And I should note, that's just my definition. If you want to define a penny stock as something else, then more power to you. That is why I love the stock market. There is no black and white way how to do things. Find something that you are comfortable with and then go with that. So where do we find penny stocks? Really, you can find them anywhere, but not too often are you going to see a New York Stock Exchange or something like that all of a sudden have a penny stock on it that crashes all the way down. First, it would have to crash. I mean, there's not going to be any sort of 5-cent stock that all of a sudden starts trading on the the New York Stock Exchange. But three main areas where you're going to find them are the Pink Sheet Exchange, the over-the-counter bulletin board. You've probably seen it as the OTCBB, and then NASDAQ Small Cap. They also have a lot of the stocks that are down in this price range. Like I said, sure, you can find them in other places, but the vast majority are going to be within one of these three exchanges. Now, this may seem kind of like a weird thing, but this is something that we take for granted because you flip on CNBC and people are talking about stocks in the market. Well, okay, that's for different companies, blue chip companies, all that. So the question is, well, okay, that's how we hear about the Apples and the Microsofts and all those companies, because they're on CNBC, Bloomberg, Fox Business. They're in magazines. They're in high-profile blogs. They're big names on the social media are talking about them. But what about penny stocks? Penny stocks only have one way to communicate, and they communicate through publicly released updates. And in the world of the wilderness, these are known as PRs. So if you hear somebody say, "Hey, such and such just released a PR," that means that it is a press release is what that stands for, but that's just a public announcement of, hey, this is what's going on, and that's how they communicate. Penny stock companies, when they announce something, it's not going to start to stream across, the bottom of the TV on CNBC or any of these, Bloomberg financial channels. The only way they're going to communicate with people, let them know what's going on, is through PRs. Again, that stands for a press release. You could call them a news release. Point being, PR means that's how, it doesn't mean public relations, which is what you may see. In the penny stock wilderness, PR means press release or just a formal update from the company. Now let's talk about some share structure basics. Now this not only pertains to penny stocks, but this is just universal. This is just, how publicly traded stocks, this is how it operates. So the first keyword that you're going to need to know and understand is authorized shares. These are the maximum number of shares that could be sold to the public. Keyword being could be. They haven't, but there's that possibility out there where if management decides, they could be sold to the public. The outstanding shares are the number of shares that have been sold to the public. So these have transitioned to these. So again, authorized shares transition to outstanding, because up in this category, they could be sold to the public, but by the time they reach outstanding, they have been sold to the public. Now the next category is restricted shares. These are the number of existing shares that cannot be sold to the public. So they exist, they've been taken from the authorized shares, however, they can't be sold to the public. Now, maybe that sounds confusing. So where would this come into play? Well, they're used within the company for management and other employees. Sometimes they are for just other sorts of financing and such. But in order for any of this to take place, they need permission from the SEC, which is the Securities and Exchange Commission. That's another term. That's in the wilderness, that's kind of the forest ranger. They're trying to make sure that everything's okay, but the forest ranger can only do so much. We'll talk more about them in the course, but point being here, the SEC has to be okay. They need permission in order before they can sell those to the general public, and there's forms that are filed and all that, so that when they're ready to sell, there's public notification. Hey, so-and-so's selling this. Maybe you've seen it in the big board stocks where, such and such insiders are selling shares of Apple, or such and such insiders are selling shares of, insert a company into there. That's what everything's about there in terms of the restricted shares. They exist, but they can't be sold. The only time they can be sold is after going to the forest ranger, the SEC, and then asking for permission. The next term we need to know is the float. The float is the number of shares publicly owned and tradable. So remember, restricted shares are not part of the float because those ones are not tradable. But the float is all shares that are traded. So the equation for that is, and when I say equation, don't worry, we're talking about, basic ABC type math, just subtraction. You take the outstanding shares and you subtract out the restricted shares, and that equals the float. So the float is just what's out there, what can be traded back and forth. So let's just look at a quick little example, make sure everybody's on the same page here. Let's say company XYZ has authorized shares of 1,000. Their outstanding shares are 700, and then their restricted shares are 200. Now, there's no such thing as well, I shouldn't say that. I don't think there's any companies out there that have these numbers, but they're just to make the math as easy as possible. So when you have 1,000 authorized, 700 outstanding, 200 restricted, so what would the float be? Well, using our basic math here, the float is the outstanding, which is 700, minus the restricted. So 700 minus 200, the float would be 500 shares in this case. Now, what about the available shares that are possibly able to enter the market? That would be 300, because we're taking the authorized, which could be, now 700 of those already have. So 1,000 minus 700, there's still 300 shares out there that might enter the market. They haven't, there's no guarantee, but there's still 300 shares that could start to enter the market, but there's no guarantee one way or another if that's going to happen. So again, authorized, there's just the possibility. That's why you're taking the possibility of 1,000, and out of that possibility, there's already been 700. So now there's only 300 possibilities left. The next key lingo here is going to be the market capitalization. The lingo for that is going to be market cap. So if you ever hear anybody talk about the market cap of something, they're referring to the dollar value of all the company's outstanding shares. So how do we get this dollar value here? Well, you take the number of outstanding shares and you multiply that by the price of the shares, and that's going to give you the market cap. So for example, there's 700 outstanding shares. Let's say they're trading at $3 a piece. The company has a $2,100 market cap. So again, you just take outstanding times the price of the shares, and that's going to give you the market cap. And that just simply gives you an idea of how big a company is. Some companies, the blue chip ones that are trading on, the New York Stock Exchange, the S&P, those have very large market caps, in the billions of dollars. Other companies aren't going to be that big, but that's just what market capitalization is. Outstanding shares multiplied by the price per shares. Dilution. Now, if you've been in the penny stock world before, I'm sure you've heard this term, but dilution occurs when the number of outstanding shares increase. So outstanding shares, we know what that is now. When that number increases, that is dilution. Now, dilution comes in two forms. There's potential dilution, and then there's pizza slicing dilution. And before you turn this off and say, what is this guy talking about? Let me explain myself. That's just how I look at the two forms of dilution. Now, potential dilution is just simply the shares that are in the authorized, but they haven't been issued. So going back to our example, remember we talked about how there's 1,000 possibilities, 700 of those possibilities have been issued, so there's 300 possibilities left. Well, now let's replace those possibilities with potential dilution. There's no guarantee that the dilution is going to come place, but the company does have the ability to sell an additional 300 shares, which would then create dilution. So again, potential is just those authorized shares that are sitting out there, and they cannot be, or they may enter the market. Sometimes you'll see people say, well, the authorized shares are maxed out. All that means in this example would be that there's 1,000 authorized shares and the outstanding shares are 1,000, meaning there is no room, there is no potential dilution because the CEO, the management has already diluted up to what they're allowed. Now, pizza slicing dilution, this is where if those above mentioned 300 shares actually enter into the outstanding share number. And maybe you're not real sure, what dilution is actually. All dilution is you lose a piece of the pie. In this case, it's a piece of pizza. So let's just say, here's my pizza slicer. There's two pieces of the pizza right there, CT, that is for Clay Trader, and then right here, that's you. So there's two shares in this company. So we each have, if this is the whole company, there's two shares, we each have half of the company. Now, if pizza slicing dilution happens, and let's say the company issues another 2 shares, well, what does that do? Now we have person A here, they get a slice of pizza, and then person B also gets a slice of pizza because now there's 2 more shares available. So what did that just do to our pieces of pizza? Now we only have a quarter. We used to have a half, but now we only have a quarter. Let's say the CEO comes along again. We need to issue some more shares. So now we have person C and person D down here that also own shares. What just happened again? We got even less pizza. So every time that shares are actually diluted and the outstanding increases, your portion of the pizza goes down. That's why I look at it as pizza slicing dilution, because there's less pizza for you. Every share that enters is like somebody slicing the pizza, and that pizza gets smaller, which means your slices get smaller. So pizza slicing dilution, that's what that's all about. Your portion of the company is dwindling. Your ownership in the company is dwindling. You own less of it because now the other people are entering into the equation. It was just, me and you at first, but now you have person A, B, C, and D all of a sudden coming to things, which is gonna, slice down on the pizza. So next, within the share structure basics, let's talk about a forward stock split. There's going to be 2 main splits that we talk about. First one, forward. So going back to company XYZ, it's going to divide its existing shares into more shares. So forward stock split means its current number of shares go into and become more shares. This increases the number of outstanding shares. However, you may be thinking, it's dilution. That's not the case because the shareholder value remains the same. So let's go over how this works. So company XYZ has 700 outstanding shares. We've established $3 a piece. So their market cap, once again, is $2,100. Company XYZ does a 2-for-1 forward split. So let's just go through the math here on the 2-for-1 forward split. There are now 1,400 shares outstanding because forward split 700 times 2. And then they're each valued at $1.50 now, opposed to $3 because we have to divide the 3 by 2. So the market cap remains at $2,100 because now there's less shares, yes. There's more shares, yes, but the price per share is less. So when you do the math again, outstanding times price per share, you still get the same market cap of $2,100. So that's what a forward stock split is, when there's more shares that all of a sudden, spring into the actual share structure. The next type of split is going to be what is called a reverse stock split. In the world, this is just known as a reverse split. You could see it just as an RS, reverse split. This is where the company XYZ, so whatever company, divides existing shares into less shares. So we're just talking about one where it becomes more shares. In this case, it becomes less shares. This decreases the number of outstanding shares. So you may be thinking, oh, well, that's good. Outstanding shares are decreasing. However, shareholder value remains the same. So nothing changes, just like in the in the forward stock split. So let's go through the math here. 700 outstanding shares at $3 a piece. We know that that is $2,100 of market cap. So the company does a 2-for-1 reverse stock split. So there are now 350 outstanding shares. So there we went. Our outstanding shares decreased in the number. 700 divided by 2. So you're thinking, oh, that's good. Outstanding shares, everybody has more ownership. However, the shares that you owned are also less now are more, but you own less of them. They were $3, and because it's a 2-for-1, you multiply that by 2, so it's $6. But at the end of the day, nothing changes because 350 shares times $6 is still $2,100. So again, it's a little deceiving. You may be thinking, all right, outstanding shares are going down. That means everything changes in my favor because there's less of it. However, all the math works out to being the exact same, and we'll talk more about reverse splits as we go through the course. But that's the math and how they function. All right, now let's just look at some accounting basics. I promise to keep this very black and white. I'm not an accountant. Let's see, I took a accounting class in college, and I think I got a C- in it. So accounting is not my strong suit. However, I promise that this type of accounting can be it's going to be very straightforward, because if Mr. C- right here, who's talking to you right now, can understand it, then you definitely can. So let's talk first about revenue. The revenue is just the dollar value that company XYZ earns through the sales of products and or services. So that's just the money that they are bringing in. Expenses, that's the dollar value that the company spends in order to earn the above mentioned revenue. I mean, you've heard the saying, you got to spend money to make money. Well, expenses are what's being spent in order to create that revenue. And then profit or loss, depends, is going to be revenue minus expense. If the number is positive, that is a profit. If it is a loss, or if it is a negative number, then that is considered a loss. So again, profit or loss is just how much money you bring in versus how much money you spend. And if that number is positive, it's a profit. If it's negative, it's a loss. Very straightforward. So let's get out our little calculators here. And company XYZ sells apples. In 1 month, they have $5,000 in revenue. Their expense to generate that revenue was $3,500. So the question becomes, was that a profit or a loss? Well, by doing the math, they spent $3,500 in order to make $5,000, which leaves them with $1,500 positive number. So that is a profit. The next month, they have $6,000 in revenue. Their expenses to generate this revenue was $6,500. So again, same question, is that a profit or loss? Well, now they're spending $6,500 in order to make $6,000. So that would leave them with a negative $500, which is a loss. So you can see, very simple, just basic addition and subtraction. So who are some of the players in the stock market, penny stock market? You're going to have the chief operating officer. This is the CEO, and bluntly put, this is the person that runs the show. The buck stops with him. He is the CEO. There's going to be lawyers and accountants. They're going to handle all the paperwork and accounting, all that good stuff. They're just making sure all the paperwork is in store. You're going to have IR, investors relations. So again, lingo time. Whenever you see IR out there, that means investor relations. And these people deal with potential investors. They build relations with investors. Investor relations, there we go. We have the transfer agent. This is the person that monitors the current share structure of the company. So if people have questions on the share structure or what have you, the transfer agent is who you'd want to get a hold of. Now there's 2 types of stock trades that occur within the market. So these 2 types are, first, long. If you're on the long side, or the lingo, if you're going long, this is the traditional thing. This is what you think of when you think of the stock market. It's just buy low, sell high. You're buying shares because you think the price is going to go higher. You only make money if the stock goes up. Like I said, it's just a typical buy low, sell high. More lingo, if there's any talk of bulls or bullish, all that stuff has to do with going long. So if this stock looks bullish, so I'm going to go long. Translation, this stock looks good, I think it's going to go high, so I'm going to buy some shares. So that's what that means. But in the trader lingo, anything to do with the bulls or the bullish, going long, that just is your stereotypical stock market transaction where you buy low, sell high. Now, going short, this may be foreign, but going short is, get ready to kind of step outside the box here. I mean, there's the traditional way of thinking. we're going to have to get outside the box a little bit for this one. Going short is where you're selling shares first. So you're borrowing them from somebody else because you think the stock price is going to go lower. So you sell somebody else's shares because you think it's going to go lower. Now, because you just sold somebody else's shares, you need to buy those back and return them to whoever you borrowed them to. So it's just reversed. You sell first and then you have to buy. But you're only going to make money is if the stock goes down. Now, you're going to have to buy back at some point, whether it's higher or lower than where you have originally sold. That's up to the market. But point being, you want the stock to go down. You sell high and you buy low. And any lingo where it talks of the bears or bearish or anything like that, that all has to do with shorting. But the key things here are shorting is selling first. But even more important thing, and the one thing that gets overlooked a lot, is you have to buy. Shorts have to buy at some point. So I want you to get that into your head right now. Shorts have to buy at some point. They start off selling, yes, which could knock down the price. However, at some time, they're going to have to buy. And as you can see by my voice, I'm kind of passionate about this topic because, as we'll see, it really gets distorted in the world of penny stocks, and it's pretty laughable the way people try to use it. I won't get anything more, but just remember this. Fill in the blank here. Shorts sell, yes, but they have to what? Hopefully you said buy. Shorts have to buy at some point, so just keep that in mind. Okay, so we've talked about the two types of stock trades. Now the question becomes, well, how do those trades actually, fluctuate? How do they gel with the market? And that's where market makers come in. The lingo for them is just going to be MMs. If you see people talking about, hey, this MM or that MM, they're just talking about the market makers. And these are entities that do what we tell them to do. We are their boss. They work for us. So how do we boss them around? What do we tell them to do? Well, it's just simple. If we want to do one of those orders, let's just talk about from the long side. You're going to say, you would tell them to buy me shares. You're going to tell them to sell your shares. You're going to say, buy me shares if the price hits X. Or you could say, sell my shares if the price hits Y. They are basically like an electronic broker. That's the best way to look at them. You're telling them where you want shares, or you're telling them to sell or buy shares, and that's what they're doing for you. They are either getting shares for you or trying to sell shares for you. But that's all they're doing. They work for us. We tell them what to do, and everybody's happy. They make commission. We are hopefully making money. That's what a market maker is. Again, I'm kind of passionate about this one too, because as we'll see, market makers get so blown out of proportion in the penny stock wilderness that it's pretty ridiculous. But at the end of the day, market makers work for us. They're the ones who go out there and get our shares. They're the ones who go out there and sell our shares for us. And then the final thing I want to go over is just a pump and dump. Maybe you've heard of these. They are synonymous with the world of penny stocks. But if you're not sure what it is, a pump and dump is just increasing the share price so that shares can be sold for larger amounts of money. Now you may be thinking, well, isn't that the whole point of the market? Yes, it is. So to me, the whole market, and that includes the New York Stock Exchange, everything is a pump and dump. The whole purpose of the market is to bring your shareholder base value. How do you bring your shareholder base value? You raise their share price, and so they can sell or dump. So the whole market is a pump and dump. But in this case, it's a pump and dump where let's just talk about the two forms. There's planned, and then there's just casualty of business. So are the companies that are trading on the New York Stock Exchange that create thousands and thousands of jobs, are those pump and dumps? In theory, yes, it's a pump and dump because they want the price to go up so people can make money and sell. However, that's not why they're doing it. They're creating jobs. They have products that are just well known. But in this case, and in the world of penny stocks, there's two that dominate the market. The first is planned, and this is just simply where the goal is to have shares rise solely for the purpose of selling shares to put into the person's bank account, whether it's CEO's bank account, financiers. We'll talk about more of that, but it's a planned pump and dump. They sit around the table and say, how do we get our shares to go up so we can sell? I don't care how we get them up. I don't care if that means we have to lie, cheat, and steal. We just need to get these up. And then there's also the casualty of business pump and dump, where the goal is to have shares rise for the purpose of building shareholder value. The CEO truly wants to build shareholder value. That is their true intent. That is their true motivation. However, just due to the nature of business, they must sell shares to stay afloat, and eventually, as we'll see as we go in deeper into the course, that just leads to bad things. So yeah, casualty of business, business is hard, but at the end of the day, it still ends up turning into a pump and dump, and we'll get into more of that later. But that's what a pump and dump is, and there's two forms that we'll learn about and discuss more. So that is the fundamentals of the penny stock market and just the stock market in general. If I moved a little too fast, hopefully you took some notes. Power of rewind is a great thing, so go back and re-listen to what I said. And I guess at the end of the day, I mean, if you're still not sure about a couple things, use those search engines. Run a search and get a little bit more information on any of those terms. But everything I've gone over, as far as the accounting, for example, that's super basic. But penny stocks are super basic. That's all we're going to need to know. So let's move on to the next presentation. Well, I hope you enjoyed, and if you did, please do a couple things for me. Hit that like button and leave a comment below, even if you just say thanks. Also, go to claytrader.com/team, and if you want to join my private community that's got all sorts of added benefits, you can learn more at that link, then please join. I'd love to have you. It's very cost effective, and like I said, if you want to surround yourself with other quality, like-minded people such as yourself, then I hope you give it some consideration. But again, if you enjoyed the video, hit that like button and leave a comment down below.